Good afternoon, all. Welcome to the weekly wrap-up for June 3rd, 2022. Get those dates mixed up. Hope everyone had a great week. We're coming to a close of a pretty rainy week here in Colorado. It's overcast again today. It was sunny this morning, but the clouds have come through and we're getting some more of that rain that everyone's always so happy to see. So anyways, if it's your first time watching this show, give me a big old thumbs up, a subscribe, a like, all that good stuff. I would certainly appreciate it. If there's someone you know out there who would benefit or get some value out of my ramblings, I would appreciate if you pass me along. So anyways, not the best day in the market. Like I've said before, it's we're going to have a lot of this back and forth, and until we finally see some capitulation in the markets, and I think we're a ways off from that. Just my experience of having done this over, 16 years now. This is not something to take lightly, and being prepared is probably the best thing you can do. And it's kind of like hurricane season. Jamie Dimon and a lot of these people have been talking about, there's a hurricane coming on the horizon. Is it going to be something small? Is it going to be, like Hurricane Katrina or Hurricane Andrew? I don't know. I mean, I just, I do my trading based off charts and, where the momentum is taking us. But I don't try to make guesstimations on tops, bottoms, how high something's going to get. So anyways, all right, well, let's go ahead and where the hell did that go? All right. Look at, see how the indexes did today. The Dow Jones finished down 1.05% at 32,899. S&P 500 down 1.63, closed at 4108. NASDAQ down 2.47%. Ooh, gave back most of the profit or the upside a couple of days ago. It's currently sitting at 12,012. Small caps are down about 1%. The VIX was up 0.28%. It's sitting at 2479 as of right now. Moving over to the other exchanges in the Americas, Canada was down 1.15, Brazil was down 1.15, Mexico was down 0.55. Headed over to Europe, Germany down 0.17, UK down 0.98, France down 0.23. A lot of words. The Eurozone down 0.3, Netherlands down 0.39, Spain down 0.22, Italy down 1.06, and Switzerland down 0.18. Got a few greens here. Portugal up 0.53, Belgium up 0.62, Austria up 0.83, Sweden down 0.3, and Denmark up 0.45. Head a little further east. The Russian exchanges finished mixed. The MOEX was down 1.37%, while the RTSI was up 0.29. Moving on down to the Asian markets, Japan was up 1.27%, Australia up 0.88%, New Zealand up 0.77%. Over to China, the Shanghai was up 0.42%, the SZSE component up 0.67%, the China A50 down 0.34%, the DJ Shanghai was either flat or closed, and the Hang Seng down 1%, and the Taiwan weighted came in down 0.73%. So kind of a mixed day in the Chinese and Asian markets. A few bright spots in, Eastern Europe, but from Western Europe on, it was an ugly day. Whew, ugly. All right. Well, let's take a look at how the week performed. Let's see here. The Dow came in for the week down 0.89. The S&P 500 looks like it was down about 1.1%. The NASDAQ down 1.28. Dow Utilities looks like it was down 0.91. And the Dow Transports looks like they finished in the green for the week. Looks like it finished up about 0.3. So looks like for the week, everything was red except for the Dow Transports, which again, with the price of energy, not to be surprised. I'm actually surprised the utilities didn't do a little bit better. So, all right. Well, let's go ahead and dive into the economic data that came out this week. Initial jobless claims came in at 200,000. The forecast was 210, so that's some good news there. Came back in under forecast. And if we look at our weekly numbers, going back a few months, a little higher than the 180, 160,000 that we were at just a month or so back. But we've been kind of holding in that low 200,000 for, was that 1, 2, 3, 4, 5 weeks now? So, it does look fairly stable at the moment, but we'll see. Continuing claims came in at 1.309 million. The forecast was 1.325. And looking back historically, hey, that's still going down. So that is some positive news that the unemployment claims are receding. All right. Let's see. U.S. consumer confidence came in at 106.4. The forecast was 103.9, so it came in quite a bit above where the forecast was. Last month was 108, so we did pull back from the previous month. So, all right. The ISM Manufacturing Purchasers Managers Index came in at a 56.1. The forecast was 54.5. Last month was a 55.4. So, hey. Came in above forecast, so we we moved up from last month's number, so that is certainly some good news there. The job openings and labor turnover survey, the JOLTS report, we currently have 11.4 million job openings, right on forecast. Last month we had 11.855 million, so that came down a smidge. So, is that people being hired, based on the jobs numbers? I don't know. Maybe it's more like people or businesses just aren't hiring as much, or they're reducing their workforce. The ADP Nonfarm employment change came in at 128,000 versus the 300,000 forecast. Last month was 202,000. So if you were watching either Wednesday or Thursday, some of the articles I was reading kind of poo-pooed on the ADP employment report, saying that it's not real, it's not the best data. So we'll see. They were saying to look at some other information that comes out later in the month. U.S. factory orders month over month came in at 0.3. The forecast was 0.7, so a little bit under forecast. And again, not the end of the world. The U.S. unemployment rate is currently sitting at 3.6%. Forecast was 3.5, same as last month, right at 3.6. And, we've been at that for this will be the third month at 3.6%. And we've been below 4% since, January was below 4. February went right up back to 4. And then we've been below 4% since then. The U.S. Participation rate, that means the percentage of the working age population that actually works. Currently, we're sitting at 62.3%. Last month, we were at 62.2%, so it went up 10 basis points. But if you look at where we were prior to the whole COVID, we were in the 63s up to almost 63.4. So it is a bit lower than what we would like, obviously. I can't really give an explanation on why there's a smaller percentage of the workforce who's actually working. Maybe it's just people just don't feel like working anymore. Who knows? All right, the Baker Hughes rig count, we're sitting at 574, same as last week, so no change there. And we're 2 off from where we were 2 weeks ago at 576. So again, I'd like to see us, here, close to 700 rigs online. I understand why the oil companies are hesitant with the current administration. They're not very friendly to the fossil fuel industry or hydrocarbon or whatever you want to call it. I understand their point. They want to have a clean environment, but we don't have the energy capacity in the grid to electrify all the cars. I mean, I heard a news report earlier today that in California, they're advising folks not to charge their cars at home It's like, well, where are you supposed to charge your car at? I mean, you come home, you plug it in, that's what you're supposed to do. But if you're going to overpower the grid, I just don't see, that is a reasonable or a rational approach at this point. All right. Got a couple or 3 articles I want to blaze through today. Keep this short. Wall Street slide, or today's recap, Wall Street slides as solid jobs data supports rate hike bets. U.S. stock indexes fell on Friday as a solid jobs report supported the view that the Federal Reserve will continue on its aggressive policy tightening path to cool decades-high inflation, with shares of Apple and Tesla weighing the most. 10 of the 11 S&P 500 S&P sectors declined, with consumer discretionary losing 2.5% and technology falling 2.2%. The energy sector was the outlier with a gain of 1.2%. The Labor Department's closely watched report shows non-farm payrolls rose by 390,000 jobs last month, and wages grew while unemployment rate held steady at 3.6%, all signs of a tight labor market. So, yeah, that's what I was talking about, that, different labor reports, some in their eyes hold more value than others. I was reading that out of that 390, I think like 80,000 of those were government jobs. So those who play along know that government jobs aren't real jobs. It's more like welfare. So they don't really add anything to the economy other than a drain on the rest of us. Quote, it's a classic good news, bad news. It seems like wage inflation slowed down. You're seeing widespread strength throughout the labor market as it goes back to our theme, which is we won't see a recession in the next 12 months, said Gene Goldman, Chief Investment Officer at Cetera Investment Management. Quote, the bad news is since last week, the markets rallied on a hopeful Fed pause in September, and now the market is saying, because this is such a strong report, September rate hikes are on the table again, end quote. I don't know why people want the interest rate pause to, again, you gotta take our medicine. We got to get on that treadmill and knock out those first few miles that are quite painful to get our cardio back in shape. So I know that, those in the banking world are in favor of keeping rates at or near zero. But, the rest of us don't like runaway inflation. We like to have our dollars keep the value that they had when we earned them. But anyways, money markets are fully pricing in 50 basis point hikes by the Fed in June and July. Volatility has gripped Wall Street in recent weeks as investors debated if the markets hit a bottom against a backdrop of some hawkish comments from Fed officials and data suggesting that inflation may have peaked. The blue chip Dow has fallen 9.3% so far this year. The benchmark S&P 500 has lost 13.6%, and the tech-heavy NASDAQ has shed 23.1%, with rate-sensitive growth stocks bearing the brunt of the sell-off. Apple Inc. slid 3.6%, hit by a bearish brokerage comment and a report that EU countries and lawmakers were set to agree on a common charging port for mobile phones, tablets, and headphones on June 7th, a proposal that has been fiercely criticized by the iPhone maker. Tesla Inc. dropped 8.1% after CEO Elon Musk, in an email to executives seen by Reuters, said he has a, quote, super bad feeling about the economy and needs to cut about 10% of jobs at the electric car maker. Meanwhile, after markets closed, FTSE Russell will announce an early list of members of its index as part of its annual reconstitution to make sure they reflect shifts in the broader market. Declining issues outnumbered advancers by 3.5 to 1 ratio on the New York Stock Exchange, and by a 2.1 to 1 ratio on the NASDAQ. The S&P 500 posted one new 52-week high and 29 new lows, while the NASDAQ recorded 30 new highs and 112 new lows. So again, we did have some bright spots this week in the market as far as up days, but again, it is hate to put a sour note on everything, but I don't think it's going to get much better. All right, next article here, analysis, Musk's warning could be an auto industry's canary in the coal mine moment. Tesla's CEO Elon Musk's super bad feeling about the economy could be the auto industry's canary in the coal mine moment, signaling a recession for an industry whose bosses have shown no signs of concern. Musk said the electric car maker needed to cut about 10% of its workforce in an email to executives seen by Reuters. He later told staff that white-collar ranks were bloated and he would keep hiring workers to make cars and batteries. Musk's warning is the first loud and public dissent in a united stance by the auto industry that underlying demand for cars and trucks remains strong despite 2 years of global pandemic. One executive this week called demand, quote, sky high. Quote, Tesla is not your average canary in the coal mine. It's more like a whale in a lithium mine. Morgan Stanley analyst Adam Jones said in a research note referring to the metal used in the EV batteries. Quote, if the world's largest EV company warns on jobs in the economy, investors should reconsider their forecasts on margins and top-line growth. He added Tesla stock fell 9%. The auto sector was hit 2 years ago by the onset of COVID-19 pandemic, which forced the closure of factories that shut down subsequently played a role in the semiconductor chip shortage that further hobbled vehicle production. Now supply chain snarls exacerbated by Russia's invasion of Ukraine. Okay, what the hell does Russia's invasion of Ukraine have anything to do with the car industry here in America? Other than the mining of the ore for the batteries, but beyond that, there's other places we can get that stuff. So I don't think we're getting, tires and seat belts from them. Where were we? Have dragged down sales. U.S. new car sales in May finished at a weak annualized rate of 12.68 million, according to Ward's intelligence. That's a far cry from the glory days of 17 million a year pre-COVID. Those issues mostly affect supply, however, while inflation is a threat to demand. Quote, risk of recession is high, so what he is saying certainly isn't extreme, end quote. Jeff Schuster, president of global forecasting at LMC Automotive, said of Musk. Ride-hailing companies Uber Technologies and Lyft said last month they would scale back hiring and curtail spending, while online used car retailer Carvana said it would cut 12% of its workforce. Other companies are watching closely. Quote, we are not as pessimistic as Elon Musk, but we are cautious about our hiring and expenditures, end quote, said John Dunn, America's CEO for Clean Energy Systems, a plastic aluminum unit that makes fuel and emission reduction systems. Industry officials worry about a possible recession. Quote, the auto industry is racing to the safe harbor of pent-up demand that could carry sales for years to come, while the looming economic storm clouds are gathering that could destroy much of that demand, end quote, said Tyson Jamani, JD Power Vice President of Automotive Data and Analytics. Josh Sandoval, the Chief Investment Officer for Greenhaven Associates, a money management firm that is a large investor in General Motors stock, has been in New York this week attending the AllianceBernstein conference. He said financial CEOs have been far more gloomy in their outlooks than other business leaders. While Musk's email sounds far more pessimistic than other manufacturing leaders, Sandoval said he has learned not to dismiss the Tesla CEO because, quote, he has zagged when other people are zigging and he's been proven right, end quote. We're in a period of, Quote, we're in a period of discombobulation and frankly, the financial world and business leadership world don't agree, Sandoval said. Quote, at some point, we'll get the answer who is correct. Well, I think Elon's probably more right than the other folks. Publicly, many other automakers still say underlying demand remains strong. Ford Motor Company on Thursday, while reporting monthly U.S. sales, said its inventories continue to turn at record rates. Quote, consumer demand is sky high right now. Manufacturers do not have the inventory, end quote. Nissan Motor Company's U.S. marketing chief, Allison Witherspoon, said Wednesday at a Reuters automotive retail conference in Vegas. And industry officials also point out Tesla has its own issues, include possibly hiring too fast compared to its growth. Tesla's employment has doubled since the end of 2019, according to the company's annual reports. And Morgan Stanley's Jonas noted Tesla's revenue per employee of $853,000 is not much higher than the much larger Ford's $757,000. In addition, Tesla's U.S. sales are heavily concentrated in California and especially in the San Francisco Bay Area that is home to Silicon Valley companies and a lot of idiots. High-tech workers and stock-based wealth are a critical customer base for Tesla, but now some big tech companies are cutting staff and smaller startups are finding it harder to get funding. All that may be true, but Musk's fears cannot be ignored, said Barry Engel, a former Ford and GM executive who founded Quell, an investment firm focused on transportation. Quote, an economic downturn is becoming increasingly likely, end quote, he said. Quote, Elon and everyone else knows it. The difference being that that as an entrepreneur, he's naturally more prone to action and voicing the truth, even if unpopular, end quote. Well, that's probably true. And I know I've sometimes upset people with my bluntness towards things. I once made someone cry because they asked a question about having more kids. And, we just finished going through the initial financial plan and was asked, hey, should we have more children? And I was like, well, no, not if you want this to work. And I'm just answering bluntly. And I probably should have, said that a little more nicely than, nope, that's not going to work out. But anyways, sorry, Mike, if you're watching, didn't mean to make that happen. All right. Last article here, more bad news bad observations from people who are in the know. Black Swan investor is watching for, quote, greatest credit bubble to pop. Mark Spitznagel is paid to be prepared for when the market's weakest links are exposed in a big way. Right now, the Universa Investments founder, whose fund aims to protect clients during Black Swan events, says the financial system is most vulnerable to, quote, the greatest credit bubble of human history, end quote. Quote, if the credit bubble ever pops, it's going to be the most catastrophic market failure that anyone has ever read about, but let's hope that doesn't happen, end quote. Spitznagel, Miami-based Universa chief investment officer, said Thursday in a telephone interview, quote, we've gotten ourselves into a tough spot. Spitznagel, 51, insists he's not a doomer and gloomer. He's long been critical of central banks keeping interest rates near zero or even negative, which he says has propped up asset values and encouraged excessive borrowing. Officials around the world are now tightening monetary policy to combat elevated inflation. That's something actually I completely agree. I mean, anyone who watches my ramblings on a regular basis knows that that's something I've been bitching about for a while. And my clients have been hearing me complain about this for years, is that, keeping rates, at such a low level all through the Obama years and, most of the Trump years, all three, Trump, Obama, and the idiot in the White House right now, they're all guilty of creating this market problem, coming out of the financial collapse we had back in 2008, it made things nice coming out of that situation, keeping rates low, flooding the economy with lots of cash with quantitative easing. I think they did about 4 to 5 trillion that time. And, it smoothed things over, covered up the potholes with some temporary fixes. But there's a lot of pent up inflation in there, and we're dealing with the consequences now. So, I think the bigger question is the inflation we're feeling today, is that from a year ago, 2 years ago, 10 years ago? If this is stemming from 10 years ago, how much, how bad is it going to get down the road? So again, I don't have an answer to that. All I know is, where we're headed is not real good. All right. His warning follows other cautious remarks this week from JP Morgan Chief Executive Officer Jamie Dimon, who told investors to prepare for an economic hurricane, and Goldman Sachs Group Inc. President John Waldron, who said he's seen an unprecedented number of shocks and expects tougher economic times ahead. See, these corporate guys, unlike Elon, they try to sugarcoat it. Yeah, it's a hurricane. Elon will just be blunt with you and say, yeah, I think it's going to fall apart. We're all screwed. And, but I don't know. I try to give you all the information. I try not to give you glossed over articles, or if I do see something glossed over, I'm going to point it out. Just because, I don't BS my clients, and, I don't want them BSing to me. I try to be a straight shooter with them. They may not always like, what I have to say, but at least they know I'm being honest with it, or at least I'm giving them my honest opinion, as opposed to what, the corporate overlords want you to say. All right, where were we? Where was I? Oh, there we are. Traditional flight to quality assets like U.S. Treasuries and gold are failing investors this year, adding to the pain, Spitznagel said. In his 2021 book, Safe Haven, he argued both were inconsistent at mitigating risks. Universa, founded in 2007 and advised by Nassim Nicholas Taleb, is a hedge fund in the purest sense, specializing in risk mitigation. It aims to protect against the biggest market crashes by preserving capital over those periods. It told clients its option traders returned 3,612% in March of 2020, according to a letter obtained by Bloomberg at the time. Well, I guess if you're shorting everything, that probably made sense. At a time when hedge funds like Chase Coleman's Tiger Global Management are caught in the middle of a rout in technology stocks, and Gabe Plotkin's Melvin Capital Management is shuddering after a string of losses, Spitznagel reiterated his criticism of the industry at large. Quote, "What purpose do hedge funds play in anyone's portfolio? I've never been able to answer that question," he said. "Hedge funds have created a solution for the wrong problem," end quote. Popular hedge fund strategies such as risk parity and lowering volatility do little to improve returns as they search for havens when markets go south, Spitznagel said. In fact, they may lose money over the long term. Quote, "You're making a market call," he said, "to make your portfolio either more or less defensive today. That would be an extraordinary forecast to make today that we're all going to get wrong," end quote. Those who tactically try to mitigate risk, quote, "are going to get churned and burned, and that's what the market does to people," end quote, Spitznagel said. So again, it's not just me who's a doom and gloom kind of, and again, I'm not a doom and gloom kind of guy. I think in the end, once we come out of this mess and the United States government collapses and we start over again, things are going to be great, but we have to get the shackles of, big government off of us. I mean, the United States Treasury or government steals what, $4 to $5 trillion a year, in tax revenue out of the GDP, which is, 18, 20 trillion. So, I mean, they're stealing a quarter of production to churn through their, whatever they spend it on. I mean, yeah, employee salaries, which I call welfare. And, it's, we could probably cut the federal workforce by, 90%, and regular people wouldn't even notice. I mean, I guess the people who like those sweet, sweet government jobs would be upset, but tough for them. So, and, to me, I think a lot of our money is just wasted on things like Ukraine and, COVID vaccines that we've been paying for the last 2 years. There's no telling how much waste is really going on and how much of that is really winding up back in our politicians' pockets. I mean, Joe Biden hasn't been in politics since before I was born because he, has a good heart and cares about people. He likes making himself wealthy. So, all right. Well, that's everything I had for today. I hope everyone has a fantastical weekend, and hopefully the weather's a little bit better. I got some chores to do on the fifth wheel. I got to hook back up the water system and make sure it's, pressurize it, make sure there's no leaks after, the freezing over the winter, and get some stuff done. Astros are in Kansas City this weekend. Sadly, I'm not there. If I wasn't going to New Hampshire in a few weeks, I would I'd be recording this video from Kansas City right now because I would be sitting in my trailer over there before heading off to the Kauffman Stadium to go watch some games. And let me say, if you've never been to Kansas City for a baseball game, it is pretty nice. Arrowhead and Kauffman Stadium are in this giant parking lot. So it's, kind of like the Astrodome is, it's out all by itself, and, which is really, really nice getting in and out. And the stadium's pretty cool. I mean, last time I was there was in August of, I guess that was 19, and it was brutally hot. I will say that the humidity is much worse at that lower elevation than it is here up at 7,000 feet. So anyways, again, I've been rambling, and which I'm known to do. So I hope everyone has a fantastic weekend. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information's there, and hope you have a great weekend. Bye-bye, folks.